Hey guys, welcome to a beautiful fall day here in Austin. I should have got a Coke before I started doing this, but oh well. All right, so let's catch up. I know there's been a lot of changes in my content lately, and I'm just trying to get it all caught up. I'm just so happy that I am able to do spreadsheets again. It is wonderful, right? Okay, let's make sure you guys can see this. I have a feeling you can't. That's par for the course. That happens every freaking time to me. All right, let's get caught up. All right, like I said, the channel's evolving. So we're about a year into this. I started mid-November last year, or really the first week in November, I think. So the way I'm looking at the information gathering stage is over. We have a year's worth of data. We have a good enough data set to work with. And like I said, the first year I had some different goals related just to some basic education. I think we've got the basic education we need now. Now we're going to start concentrating on drilling down on the specific strategies and how the strategies really work and how it affects the ETF's return stream. That's one thing. But then what we're really going to do is we're also going to learn how to apply the strategies in our own trading when it's appropriate. All right, so I have lots of new content coming out, especially about applying the strategies. We're going to do one today in an earnings stock that has earnings after the bell. Stick around to see what that is. I'm going to give you guys a free winning trade and a badass winning trade. It has like an 82% chance of profit. Okay, so stick around for that. All right, but so let's catch up. Did anyone check out my videos on erosion from the past couple of days? I did a part 1 and a part 2. A lot of you guys watched that. I had good some good comments on that. I'm glad you guys enjoyed those videos. I've had those videos written for a while, but I needed the retirement simulator to work before I could put those out. And I have a whole bunch of other videos that have been written for a while, but I was unable to put them out because the spreadsheet problems. Now the spreadsheet's working. We're going to start getting videos coming out one after the other. So I hope you guys like that because I have a backlog of videos. All right, so watch my erosion videos if you haven't yet. It's kind of beginner's content. If you've been here for a while, you probably already know everything it is. But the way back retirement simulator is really cool. Be looking for that. I'm going to have a new way back retirement simulator video today. That's all it's going to be about. It's going to show you how to tell if you're over allocated in high yielders. And should these high yielders come with a warning label? In the old days, your broker probably would, and your broker's boss would have needed to sign off on you trading this style of trading for your account. And you'd need 7 figures. Nowadays, anyone with an iPhone can sling options. It's awesome. Okay, so I really like my series from last week, Trades Inspired by Jay and ULTY, and that's kind of one of the new directions of the station. So we're going to, Law and Order rips stories from the headline. Well, we're ripping trades from ULTY. ULTY had a home run earnings trade last week in Netflix. I guess I've thought about that kind of trade, but it's kind of an unusual trade that's not an everyday trade. Well, it's a genius trade. So now I'm looking to see which other spots we could apply that same trade. And that brings us to today's trade, which we're going to talk to in a second. But I named this strategy that I stole from the Netflix trade from last week, the loaded dice spread. We'll talk about the ins and outs of it in a second, but it's like having loaded dice. It wins 80% of the time. I mean, a normal option trade wins like 67% of the time, selling just a normal option. This one wins 80% of the time. It's huge. Okay. So we're going to check out that trade and some of the other trades from next week. All right. I suggested one in Amazon last week. We'll look at how that's doing. Then I also discussed something, and I didn't have a name for it at the time, but now I'm calling it the loaded for bear spread. And we're going to look at one of those. So let's look at this. But first of all, let's stick with the J inspired spreads. And let's start with the ones from last week. So here's the dates on them here, October 24th. J Inspired Trade in Amazon right there. It's up $41 right now. Well, let's look. So Amazon has earnings. Amazon has earnings after the close on Thursday. Okay. Well, today, I noticed today after the close, we have AMD. We have AMD. And we have an AMD earnings that I showed you guys last week. And if you have this one on, what you're doing is it's a bullish play. You want prices to be above 156 or something, but AMD has earnings this week. They have earnings after the bell. All right, so we'll see how that does. We'll know by tomorrow. We'll know a lot more on that one. And like I said, I gave you that one last week. But if Amazon's up, or I'm sorry, if AMD is up 10% or something, this would be a $500, $600, $700 winner or something. The great thing about these is if you miss it, and they miss earnings and they're actually down a bunch, they drop 10% or something, you get paid there also. You just don't want a no move. You're just trying to avoid the no move on this, and you would definitely rather have a bullish move. So that's an interesting trade. And also that one right now is up $145 before, and they haven't even announced earnings yet. But we'll see what it's at. We'll see tomorrow. Could be a difference. Okay, now I talked about the loaded dice spread. So here's a loaded dice spread idea that I gave you guys last week for Facebook, Meta, and I don't believe they've had earnings yet. But this trade you put on for a credit, it's 4 legs. You put it on for a credit of $140. You have an 83% chance of profit. This is the loaded dice spread. It's like shooting loaded dice. This is what Jay did on Netflix. Okay, it's too late to do this one. Don't do that one. I have a new one for you today. If you're interested in that type of trading. But you can see the ones I gave you last week all worked out. AMD earnings idea plus 131. The earnings idea for Meta up $800 one way. Another way, the loaded dice way is up 268. A different alternative is up 270. Okay, so now here's today's. It's going to be in Google. It's loaded dice, and it's going to be in Google L. They have earnings after the bell. And to me, this would be a really good trade. And the prices should be fresh. There's tons of liquidity. Look, these options are a penny wide and tons of volume. Penny wide, tons of volume. Trading Google L right now is almost like trading the SPY or something. They have earnings after the bell. So the reason it has such a high win percentage, for one thing, look, this thing can drop. It can drop 6.6%, and the trade still makes money. The trade for a credit of $80, but you get to keep that $80, and like 81% of occurrences you win. Some of those outlier occurrences you win a lot more than $80 also, but you have cap loss on the downside. Anyway, I'm going to share this trade. So that's the loaded dice spread in Google L. And those prices are fresh, and those are realistic prices. And here's the key I look for. I look to make sure that I'm getting the credits at least a tenth of whatever the max risk is. Max risk is 800, credits $80. That's what I like to look for at a minimum. And then I like to have at least an 80, 81, 82% chance on these loaded dice spreads. What you're doing is you're selling a put spread to buy a call spread. What this takes advantage of is option skew, and it takes advantage of when puts are priced too expensive relative to calls. In fact, the more expensive the puts are relative to the calls, the more attractive this type of trade is. But it can also work when calls are overpriced. You just have to change we can talk about that in depth some other time. Anyway, I'm going to share that with you guys. So that's Google L. That's your loaded dice free money trade of the day. That thing, they have earnings after the bell. You saw all the other ones were up $200, $300, $600, $700, $800. The ones I showed you last week. So we'll see. We'll see if the hot streak continues. But all right. So we also talked about the loaded for bear spread, which is a back spread. We're going to talk about that in a second when we talk about Peter Zeihan. It's a different type of play. All right, Kamala's price is way too low at Polymarket. I know you guys know that. I don't know if anyone's interested in that content, but you can bet Kamala at one place and Trump at the other place and lock in like a 10% profit for a week, no matter who wins. I have some videos about that. Today, the odds even improved a little bit more, meaning Kamala's price dropped, and I think Trump's price stayed the same. But the further their prices are apart, the bigger the arbitrage is, the more attractive the trade is. Anyway, so if Kamala's price drops and Trump's price stays the same, well, now actually you want Trump's price to be as low as possible also. Well, anyway, whatever's going on, it's Trump's kicking ass right now, according to the betting markets. But because of that, at Polymarket especially, you can bet Kamala and then Trump somewhere else, and there's a discrepancy. All right, so but something I don't know if that many people are interested in that, but something that I do want to talk about is that I told you guys a couple of weeks ago, and about a Uber MAGA bull spread, volatility spread. Well, those are all up hella money. You probably need to take those off if you have those on, or take some profits. So let's look at that really fast. That's one other thing I want to catch up on really fast. I think it would be discretion's the better part of valor, is something my mom always taught me. My dad always said you never go broke taking a profit. But so a couple things. We have an Uber bull, a DJT Uber bull. Well, all the DJT ones are killing it. Even the clusterfuck spread that I just showed you, like on the 18th, is up $152. The one I showed you on the 16th is up $190. There's one of them that's up $1,000. It's this one, the dark MAGA. If you did this one, if you did the dark MAGA, or this one, the new dark MAGA from October 10th, either of those, it's time to take your profits. I mean, I think, I don't know, though. That's tempting to stay in and just stay in for the short squeeze. Well, you do you on that one. I would take like half profits. I would take it costs $500 to put on. I would at least take $500 in profits so you could free ride the rest if it keeps going up. I don't know. All right, well, that's been a good call. I mean, this trade makes money off the stock going up and volatility going up, and both things have been happening at the same time. Now, more recently, because the stock had already moved up so much, by the stock I'm talking about DJT, I recommended something called the clusterfuck trade. Well, even the clusterfuck trade is just doing awesome. So let's take a look at it. This one right here. It's up $187. It kind of overshot the profit tent a little bit. This trade is aiming for 40 and the stock moved to 50. If the stock keeps moving up on a trade like this, it actually makes a little less money unless the volatility keeps moving up at the same time. Still makes a little less money, but it's still a lot of money. If this goes to 150 with increased volatility, this trade's still a $600 winner, and it costs $400 to put on. But it's not like the dark MAGA trade that makes exponential, that's up, $2,500. The dark MAGA trade owns one extra call option. So this trade makes more sense, but it's also a little bit less wildly bullish. But this is still pretty wildly bullish. Anyway, we'll keep an eye on this into the election. Volatility should stay up. I've showed you a jillion times. If volatility goes up, and it will, or as long as it stays up, wherever the price of this thing ends up, it should be favorable for somebody that owns this spread, in my opinion. But probably here soon we'll roll this into December or January. We'll talk about that later. At some point, we'll take the profit on that and roll that into December, because I bet the volatility stays through December. I bet they challenge us all the way through January. I bet goes to the Supreme Court. And so anyway, I think volatility should stay up. We'll see. Okay, so let's catch up with this. Yeah, Kamala's price way too low. Just relative to other places, not making a judgment. Okay, the Peter Zion video, did you guys see that? He said there was a 1 in 5 chance of war in the Middle East that could send crude prices skyrocketing. Now, it's going to be worse in Europe than here, but I looked at a couple of trades to take advantage of this, and this was a good use of what's called the loaded for bear spread. Okay. Now you would think the loaded for bear spread would be bearish, and sometimes it is, but in the Peter Zion case, he's bullish on oil. So, but I shared this trade last week also, and I shared it 2 different ways. I shared it doing the loaded for bear spread way, and then I showed it just buying options. Some people aren't approved for spreads, so I showed it both ways. Well, you can see right here, the loaded for bear way, the spread way is actually up a little bit, $7 right now, where the just buying options is down $155. Why is that? That's because the price of this option is eroding. You know, when you buy a long call option, yeah, these things erode like crazy. So I mean, and it's eroded most of its price away. But that's what happens unless you get the volatile move, the directional move, or the move in volatility, right? So, but now let's look at this. The cool thing about the spread trade also is if you're wrong, you still get paid, and that's what it's setting up for right here. Peter Zion's wrong about as often as he is right. He made a follow-up video to that video that I haven't told you guys about yet, but I'm thinking about making my own follow-up video where he said he could be wrong, and there's also a chance there could be a price war breakout between the Saudis, an oil price war, not a shooting war. There could be an oil price war. And this is about a 1 in 4, 1 in 5 chance also, he thinks. It could happen at the same time as the other one, or they could both happen. But he also thinks there's a slight chance of $50 oil. Okay. Well, if you do a spread like this goes out till January. And if oil price keeps dropping, you still get paid. Okay. You're getting the income, the credit you get is more than 1/10 of the risk. That's always what I like to look at your max losses. So if it drops, you still make the $156. But if God forbid he's right about a shooting war, even if it doesn't get to 300, if it gets to 125, this trade's and this goes all the way till January. This doesn't expire till tomorrow. This doesn't expire tomorrow like most of the stuff I give you guys. This goes out till January. Even if you get a price of 120 crude, it's a $2,400 winner on this trade. And if you're wrong, you still make $150. That's what's so powerful about these loaded for bear spreads. And therefore, when you really think there's going to be a strong directional move, that's where the loaded for bear comes from. You can do these in the bearish direction also. But anyway, I think that's an interesting spread. Now, here's the other one. But a lot of people don't understand how to do that, or aren't approved for options. Maybe they can just buy and sell calls, maybe do covered calls. They kind of have the basic approvals. Well, for those people that still want a piece of this trade, you can still profit if oil blows up. You just can't profit if it goes both ways or whatever. So let me show you how that works. Here's where you just buy a call option. It's actually down because this is the one where it's eroding. So this one, you need a move to even break even. You need a 26% move. But if you get that price of 120, like we talked about, this trade is worth $3,200. So this trade's a little more profitable, but you don't make money if you're wrong. You for sure lose $255, if you don't get a 26% move in your favor. These are what's known as sucker bets. These are what you try to avoid doing when you do options. You don't want to be the guy that does these. And that's why I'm showing you guys. And that's why I'm taking stuff we learned from Jay. Jay makes smart money bets at ULTY. I'm showing you how to apply that, how to apply hedge fund style or option trading in your own account. Okay. So let's look at this. Okay, back to this spread way, this back spread. What this does, all you're doing is you're taking the 73 strike call. It cost $6 the other day when we put this trade on, but it's only worth $3 today, but you're selling that. Okay, so you brought in nearly $7. Then you go further out of the money and you find two options you can buy that together don't add up to $7, something like $2.50 or $3. You buy two $3 options, that adds up to $6, but you sell a $7 option. Then you have a valley of death. Yeah, you create a valley of death just like this. The valley of death is right at the bot strikes. The two strikes that that's where, but this is it. But these are interesting trades because if you're wrong, you still get paid. And you can put these types of trades on for a credit. Whereas, and if you just do the option by itself, you can't. Also, the option by itself has to move 26% to break even. This one, to be fair, has to move 39%. So you need a bigger move from this. This one, you're trading a valley of death for a little bit of income and a profit, even if you're wrong. But these trades take a tremendous move. You're looking for like a 40% move in oil. But if we're talking $300 oil and we're at 85 right now, this trade makes a lot of sense, right? Okay, so that's why I showed to you guys. So it's too late to do that one also. I don't think anyone really made very many positive comments about that. Let me know if you guys are in any of these trades. Write me in the comments, but I just want to catch up on all of them. And I wanted to give you the one in Google today. This one in Google is a great trade. I'm telling you, you can thank me for this later. Take your wife to dinner. I know $80 isn't very much. Do it 10 times. You're going to risk 7,000, but you're going to make $800. I mean, if that meets your goals, if $80 doesn't get you going, you can do these multiple times because there's no commissions. And the bid ask on these things are a penny. They're easy to get in and out of. Put this on, anyway, this is a good trade. I hope you guys make money on that. All right. So what else do we want to look at today? The Peters IHAN, it's too late to do that one. All right. So the volatility trend following system, that I mention all the time. It switched to bearish again yesterday. It's getting whipsawed. I've talked about whipsawed and what that means, but I think the volatility system stopped working in front of the election because volatility is so elevated. It goes up even though the market doesn't go down. Like right here, volatility went up, causing my system to be red. Well, the market went straight up even though volatility was going up at the same time. So who knows? But I expect better results after the election. But as of yesterday, this thing turned back to bearish. And that's how so really this whole time it should have never switched to bullish. It should have just stayed on red. And I told you I feared that might happen. I feared the green might be a fake out. I also fear, but basically when the market's going straight sideways and you're trying to do a system that uses a moving average or uses something that tries to use a trending element for a filter and you don't have a trend, then you get poor results. That's what we're having now. But I'm still going to keep an eye on this. Here's what I think is key to look at. This right here, this is the VIX of the VIX. And this showed you people jumping into volatility yesterday. And of course, the market did pull way back, and maybe that's why the market bounced this morning. But who knows? Maybe this one will be another whipsaw too. But that's not a bullish look. That's not a bullish look, and neither is this, because this is just the normal VIX, and this is above, and the stayed above for a few days, and the moving average is getting ready to turn up. So it's just not a bullish look. We got the election coming up, so I'm going to give you guys one more trade. All right, this is a loaded for bear pre-election hedge. This is one of those back spreads. What you're doing here is you'd sell the 587 put. Well, there's no volume on this today. This is a bad one this is a bad example. Well, how did I have no volume on this today? I'm trying to go out till after the election. Let's go to the day of the election. Okay, well, we have volume, so it's the same trade. Okay, basically the same trade. Okay, so you take your wife to dinner. It's a $209 credit, and this is if you think that if you think the market's going to crash due to the election. A lot of people thought that last year, in 2020, and I think it was down for and they thought that in 2016, and both years is down for just a little bit, and then it just turned around and shot up. So I'm not suggesting this trade at all, but this is just a way to protect yourself and build, and you can make a little credit. That's kind of the theme of these trades. These trades where you can make a credit, you can get paid if it goes either way. These are more like volatility trades, and these are more similar to trades Jay is making at ULTY. He doesn't make this specific trade at ULTY. He did make something similar to the loaded dice trade. He does do that. So anyway, this isn't Jay inspired. This is Max inspired, but this is a decent way to take a bearish shot. If something happens and, we open up the day of the morning of the election, the market's down 5%, this trade's worth $1,300. If you're wrong and everyone loves whatever happens and it's buy the rumor, sell the news and whatever, and Max is wrong and everything's great and one of the candidates concedes and it's morning in America and everyone's happy and there's no challenge and it's just the most peachy, beautiful day ever, market will probably go up, but you still get your $211. You're just trying to beat a no move or a down 1%. I'm going to call that a no move. You need an outlier move. Okay, so that's going to be in the that is a decent way to take your wife to dinner, earn a credit, put the odds in your when you earn a credit, it helps put the odds in your favor. Watch this. We're going to get a quick impromptu option lesson. This option strat's really good. You guys should get it if you don't have it. I applied to be an affiliate. I mean, I really believe in this product. Okay, so here I made a copy of the trade. So here is, let's just get rid of that. Let's not sell that option and let's not buy two options. Let's just buy one option. This is a way to compare the two trades as much of an apple to apples as you can. So this is where if you just buy the option instead of messing with the spread, you buy the same option. So you buy the 574. Your break even still at the same spot, I believe, right? Break even's at 565. Your break even's a little lower when you do it that way. Okay. You have a better break even this way. The white line is the other way. The problem is you lose money for sure, no matter what happens, unless the market moves 2%. So that's you, but you can do that also. That's another way to do that. Just buy the 574 option. If you wake up the morning of the election and we're down 5%, that thing will be worth $1,700 profit for you. So that's one way to do it. Just buy the 574. The other way to do it, and I'll share the trade in the notes, is the back spread, because you aren't really paying for the option. You're selling this option to pay for these two options. So, that's how you can get paid if you're wrong and you make $200 no matter what. Well, you get the $200 income no matter what. You can keep it in 53% of the chances of the occurrences. Okay, now the other way, when you don't do the spread, when you don't sell the option, you cut your chances in half. Okay, so now let's look at upside. The 5% upside is 1,800 this way. And if you get a 5% move, if you do it the spread way, you make 1,200. There's no free lunch, just like anything else. I think it makes more sense to do it this way. But anyway, all right, let me know what you guys think. So, like I say, I'll share that in the comments too. Sorry, this has been a long video. We had a lot to get caught up on. And then I still owe you, I'm still coming out with the ULTY video today and the Yield Max video today, and those will be on next. All right, so here's the review. We're long oil because of Peter's eye hand, and we have, what's it called? The loaded for bear, bullish loaded for bear spreads on oil. All right, we are long SPY back spreads just in case the election goes shitty. I just showed you that trade just in case we wake up there. And we could also just be long a put if you don't know how to do a back spread or don't want to. But I would recommend learning how to do a back spread. It doubles your batting average. It literally doubles your batting average. Okay. When I learned how to sell options instead of buying options, it was life-changing. I always start from the selling side. Sometimes I will also buy an option, but you guys will see. I'm showing you. All right. We're long oil, and then we're long SPY puts or long SPY back spreads. Okay. And then long the loaded dice Google spread. That's not a bad trade. And if you've done those, if you did the Facebook or the other ones that are up a couple $100, take those off. There's no reason to roll the dice. If you can make $200-300 before the earnings even come out, I just take those off. That's all you're trying to do. These trades, you're trying to make 10-20%, and you're trying to do it like 80% of the time. And you'd be surprised that how often you can do it. That's why I'm so excited about these trades. One thing I did want to mention, one big caveat, but it's something you can also add into your own trading. Okay, it's the loaded dice spread, and it was this Google custom one. So let's look at this. It's already up $7.50. One thing I want to mention, what Jay actually did on Netflix, he didn't do this spread just by itself. Okay, and he doesn't do any of them by itself. He did this spread on Netflix, this type of spread. He sold puts to buy calls. He did it for credit. He did it on top of owning the shares too. And that's the way, and that's kind of the way that's the way that everything works in ULTY. They either own the shares or own a synthetic, but then they do an option strategy on top of it. Well, you can see it gives us this real funky, profit loss graph. But all that is, and I've showed you that Netflix trade at least 3 or 4 times. I've showed you he's triple long. This trade, you're long through the Google shares. He's long through the Netflix shares. But then you're also long. When you sell puts, you're long. Okay, because when you sell a put, you're agreeing to buy stock. Buying stock is long. Okay, but when you sell calls, you're short, of course. So, but he's actually, these aren't selling calls though. He's selling. They are selling puts because this is selling a put spread. This is buying a call spread. This is a long call spread. Selling puts to buy calls. This is a triple long play. Now, the way I showed you guys how to do it, I don't like that. You can do it plus owning the shares. That's a legit way to do it too. Take it through earnings, same thing. You'll make a little extra money if it lands. And that's the way Jay's doing it, because Jay's doing it more for income. I'm showing you guys how to do it. Just ditch the shares. Ditch the shares and turn it into an earnings trade. This has a tremendous advantage just due to the fact that this is like starting a 100-yard dash 50 yards ahead or 40 yards ahead, because you can drop 6.4% until it loses money. I mean, these are really interesting trades. Anyway, this is exactly what he did in Netflix, only he did it with the shares in ULTY, because Jay's going for a different type of return. The shares give you a more stable return. When I'm showing how to do option trades, I just like the option element of it. We just, you can make the same income Jay made. The credit's the same. Jay just took the credit from the options, pays it to the dividend holders, and just keeps the stock. And if the stock goes up, it goes up. If it goes down, it goes down. But either way, you get your dividend, right? So, and there's virtually no tax on the upside when you do these types of trades, or there's less tax on the upside than when you do straight covered calls. All right. Now, I've talked about that a million times too, but I appreciate you guys being here. Let's see what else we have to talk about. All right. I need to get on these other videos. I'm not trying to ditch the Defiance video. The Defiance videos are morphing into the ULTY and Yield Max video. More people are interested in ULTY and Yield Max. And also ULTY and Yield Max are doing the more interesting option trades. Defiance is a great thing, but it's not as interesting to study from an option trade point of view. We're going to make our option trading better this year, not just our ETF trading, but that we're going to make that better too, right? All right. Thanks for being here. I'll share all those trades. I think there's 3 of them. Hit me up with questions. If you have, especially if you have questions about how the trades work or whatever, and if you aren't sure about them, start with one lot, put it on with one lot, try to hit the bid and ask, tasty trade. I just move it to the middle, try to get in the middle, and I leave it for a couple minutes. If I don't get in the middle, just keep moving it keep moving a little bit their way until they take it. But these ones that are soup, that Google Trade, you'll get it like that. All right, guys, I appreciate y'all for being here. Have a good day.